The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A heavy lift today from the Mag 7, and not much from anyone else. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele, and volume really light, too. It's hard to make a lot of... I don't know. We're here. Where's everybody else? Let's take a look at where the S&P stands right now. Pretty much flat, going nowhere fast. As Romaine was pointing out, it was really the upside in the Mag 7 that's outperforming, up by 0.4%, though it's not all tech, even though tech might look like a safety trade today, because you look at the semis, and the SOX index is down 0.4%. So you can really chalk it up to some of the big movers like Apple hitting another 52-week high. Romaine, I just wanted to point out, though, the 2-year, because part of this also might be a safe haven bid, right? Safe haven into tech, safe haven bid into the front end of the bond market.
Yeah, you do kind of wonder what's really driving that. 0.4% might not seem like much, but that is going to be a record high. A third day of gains for the Mag 7. That's assuming the green on Alex's screen continues to burn bright until that 4 p.m. close. And now this is a big flip from the trading days prior, where investors had really shunned big tech in favor of small cyclical. But ultimately, cash is king for investors, and as NYU professor Aswath Damodaran tells Bloomberg, when it comes to cash flow, he's never seen a group of companies carry a market for as long as the Mag 7 have.
I've never seen cash machines as lucrative as these companies are. And I don't see the cash machines slowing down. I think the pricing might be getting out of control, but they are pricing in companies that are deservedly among the best companies in the world.
But hold tight here. There's going to be another test of the tech trade tonight with the release of earnings out of Salesforce. While artificial intelligence has been a major driver of stock market gains for almost 2 years now, the biggest revenue boost so far has been to chip makers like NVIDIA, cloud companies like Microsoft. Investors, though, they are betting that software makers like Salesforce will be the next group to benefit. That will be seen later tonight, but we'd be remiss in not pointing out that the tech trade remains insanely crowded and frustratingly one-sided, with little downside hedging apparent, gutsy positioning, particularly in light of broadening geopolitical risk. That includes the fighting in the Middle East, the unrest in Georgia, an unraveling government coalition in France, and a declaration and then a rescinding of martial law in South Korea. All enough to raise eyebrows, but not enough to derail an MSCI World Stock Index that's on its way to notching yet another record high.
Which then makes it make sense why you might see a little bit of money near the front end of that bond market today. So this is the basic latest survey from Bank of America Global Fund Manager Survey. And I wanted to point this out to kind of back up Romaine's claim that tech is really highly owned. The long Mag 7 stocks is identified as the most crowded trade. Gold comes in second, and then the dollar comes in third. The orange bar is where we are in November 2024 versus the blue bar in October of 2024. Now, what's interesting is on the same day, Savita Subramanian of Bank of America says that she is ready for a cyclical inferno next year, quoting a target of 6666 for the S&P, led by cyclicals along the way. It doesn't necessarily mean we're going to ditch tech, but it's going to be the cyclical trade and that rotation, not that heavy weighting in tech, that's going to drive us higher.
6666. All right, I'll be keeping an eye on that, Alex Steele. Let's kick you off to the close here on this Tuesday afternoon. Sinead Colton Grant joining us right now in Studio 2, the Chief Investment Officer over at BNY Wealth. All right, Sinead, you heard that, it's still a crowded trade, and there's a reason why big tech remains a crowded trade. But a lot of questions about the broadening of this rally, particularly as we head into 2025, and whether we do see, a reassessment of some of those small and mid-cap names. People are going to be more interested in that than maybe just big tech and the cash flow that they generate?
Well, there are a couple of things there, Romaine. First of all, AI is a productivity step change, and we have to remember how that's going to permeate throughout the economy. But when we think about tech overall, yes, the PEs are high, the multiples are high, but when you look at the margin expansion that we've seen in the S&P over most of the last 10 years, the vast majority of it has come from the tech sector. That helps a lot, but we do think you're also going to see some rotation, right? We like mid-caps as well. We like the fact that they are not as hostage to interest rates as small caps are. And we do think that industrials and some cyclicals should do better in this environment.
Is there, though, a theme around that, or are those going to be more idiosyncratic stories where you're just going to have to really kind of go stock by stock, or maybe even subsector by subsector, rather than sort of a broad aggregate move higher for everyone?
It's always individual stock specific. And look, stocks come back to the fundamentals, your earnings and interest rates. Earnings will help individual names, interest rates are going to help across the board. So when we look at the market, though, we take it back to the US economy. And one of our very strong beliefs for the next 12 months is that the US economy is going to continue to outperform every other major developed economy. The thing that we don't talk about enough is the fact that if you go back to just before the pandemic, end of 2019, since then, cumulative growth in the US has been 11.4%. The next closest developed market is the EU at 4.9%, so less than half. And that is a huge tailwind for US stocks.
So US exceptionalism, that theme continues in your mind?
We would call it American leadership, absolutely.
Okay. So does that mean that does it have to stay with tech, or can we still stay American leadership if we broaden out, considering that we're so heavily weighted to tech?
And we think it will broaden, in part because you're going to see benefits coming through from AI to other sectors. We think healthcare looks interesting from that perspective. We're also starting to see the first signs of potentially application in the energy sector too. So AI implications are broader.
What throws you off? Like, what would be the thesis that worries you the most there?
It is less about the technology sector and more about broader risks. So you mentioned a few moments ago a number of geopolitical risks that are out there. We also think a lot about the outstanding level of government debt here in the US. It is high. The US is very much a beneficiary of the fact that it's a high yielder in the context of most other developed markets, so there's a huge appetite. However, debt service costs are high. We're paying a lot of interest there. We pay more in interest costs now than we spend on the entire defense budget. That's a challenge. It also means when we're thinking about changes in regulations with the new administration, how they want to supercharge growth, they've got a different ability to maneuver than they did back in 2016, 2017, when the level of the debt was much, much lower.
I am curious about how you allocate in the fixed income space. I mean, we talk about the healthy gains that we're seeing in the equity market. You have some pretty healthy gains in fixed income, at least on a year-to-date basis. With yield changes, I don't know if they're going down or up, but yield changes that I think most people are anticipating. Is there an opportunity to open new positions, or do you sort of reevaluate the positions you already have now and maybe trim?
There are a couple of important things to bear in mind here. The first is that now that yields have normalized relative to where they were following the financial crisis, the yield at which you invest is really the biggest determinant of what's going to generate your return over the long term. And so yields look reasonably attractive at these levels, in the mid fours, call it. We think corporates also look attractive, and we're starting to like high yield as well, a little bit at the edges, because we think the economic performance is going to continue to be strong, default levels will be low. But here's the other thing. If you're a taxable investor, you really need to think about a taxable equivalent yield, and so that's where municipals come in. If you start looking at beyond the 10-year area, in still high-quality names, you can get taxable equivalent yields that are north of 7%. Now, you have to be very judicious. That's where security selection comes in.
Yeah.
But that's an equity-like return from a bond. You don't see that very often.
Yeah, absolutely. Go ahead.
And the final thing is just be ready for volatility, because we think that yields are going to continue to be volatile. Our range on the 10-year yield for the entire year next year is 3.25% to 5%. That's a big range. But there are a lot of factors that we think are going to cause that volatility, much as we saw this year. And that's a huge opportunity for an active manager.
Are you getting any from clients? Are you getting any concerns and questions raised by them about how the political risk factor into the market risk, and whether they should be trying to sort of, I guess, maybe make sure their portfolio is somewhat immune to some of the political changes out there?
It's a great question, because over the last couple of months, we have been talking a lot with our clients about politics. But you know the thing that we keep saying? Don't invest with your politics, because markets can go up and have gone up under all types of administrations. And there's a lot that we don't yet know. There is a big difference between a policy platform and what eventually is implemented. And look, the most important thing is to be allocated in line with your risk tolerance, and then tactically make adjustments as you see opportunities.
All right. Well, sounds like sage advice to me. Sinead, always a great conversation. Sinead Colton Grant, the Chief Investment Officer over at BNY Wealth, kicking us off to the close here on this Tuesday afternoon. When we come back, a focus on politics, a focus on President-elect Donald Trump and his reiteration of steely opposition to Nippon Steel's attempted acquisition of U.S. Steel. How the president-elect hopes tariffs and tax incentives will keep the American steelmaker right here in America.
You didn't weave my steel in there in some capacity. We'll work on that. All right, Bernstein warning that FedEx might not be able to deliver value to shareholders. What problems the firm sees looming over the delivery giant.
And it might be the bread and butter of private equity's foray into the food services world. A conversation about Blackstone's acquisition of Jersey Mike's. A sit down with the sandwich chain's founder and CEO, not only about his business, but about his philanthropy, particularly his partnership with Best Buddies International. All that and more coming up in just a bit, right here on The Close on Bloomberg.
All right, shares of U.S. Steel are down almost 8%, with President-elect Donald Trump stating his opposition to a buyout by Nippon Steel. Now, Trump saying he'd use tariffs and tax incentives to revive the American steelmaker. Joining us now to discuss is Timna Tanners, equity research analyst at Wolfe Research. She's a buy rating on the stock and a $43 price target. Can U.S. Steel make it alone?
Oh, 100%. I don't know how to make it any clearer except for that they have one of the best balance sheets of the coverage that we have. They got to, refresh their whole balance sheet during COVID. That really helped them out. And now they have a really nice, tidy business between the new electric arc furnaces starting up and their traditional blast furnaces. So actually, they're very well positioned.
So why does the market punish it so much whenever we get the headlines from either President Biden or President-elect Donald Trump that the deal won't go through?
I think you have a lot of risk arbs that are owning this name right now, and so they're dominating. I think the dust will settle once one way or another something happens, and it will start to trade a little more normally with steel market fundamentals.
Do you think we'll ever get to a point where we'll see broader competition in the U.S. steel industry overall?
Broader competition in what way?
Well, meaning having more than just basically one or two companies in the space.
Yeah, I mean, right now there's probably a dozen flat roll producers in North America, including Canada and Mexico, which maybe is presumptuous these days. And then you have on the rebar side maybe 6 or so. I think that's not a bad number. I'm sure those in the market want to have even more concentration. I think the bigger issue is imports, and actually what you're seeing is more domestic production, more tariffs probably on the horizon, keeping those out of the market. So I think you've got a pretty stable, decent price of steel. The market would always like it higher, but it's not terrible.
When we talk about this whole idea of why Nippon got involved, and more importantly, why there was such a visceral reaction against it for a lot of folks here in the U.S., was this idea that we've kind of lost a good chunk of our steel industry, and U.S. Steel is kind of at least seen as kind of the main sort of highlight, I guess, of what's left there. And is there a case where we can push back on Japan, or for that matter, any other foreign company looking to buy it?
Yeah, I think this case got super politicized because of the year that it was introduced. And I think, if it had been clean and tidy and done before the election, nobody would have thought about it twice. In fact, about a decade ago, more than 10% of the U.S. steel industry was owned by Russians. So, now most of the steel industry is U.S. owned. And I think the impetus of this was not that the, steel industry in the U.S. needed help as much as the Japanese industry needed help, because the Japanese are a melting ice cube. Right? They've lost their industry to China and to a shrinking population, right? So they saw the U.S. as an opportunity. All the Japanese automakers had already moved to the U.S., so why shouldn't they? And Japan is our single largest foreign direct investor, I believe. So, it didn't really seem like it would be a big issue until you layered in the election year, I believe.
Such good perspective. So then to that point, if we get, say, tax incentives or something else or other kind of incentives from President-elect Donald Trump, what would what would the U.S. steel industry here, use that for?
I mean, the steel industry right now has prices that are below the levels that they'd prefer to make profits, right? So if they had more tariffs, they'd be able to charge a higher price. But then there'd be broader repercussions about steel consuming industries like the automotive sector that would be even less competitive, arguably, or other appliance sector. Then you'd have to put tariffs on appliances and auto more and put even more of a moat around the country, which is where we seem to be headed, right?
So let's talk more tariffs then, because if we wind up getting more tit-for-tat tariffs, whether with Canada and Mexico and China, we saw it today with some rare earth metals from China, how does that affect your world? What do you think U.S. companies are going to do with that?
On the positive side, I think our sector, the U.S. steel industry, would be able to produce more And there is more capacity coming online. There's about 5 million tons that we've identified that wants to restart or come online. So that would displace those tariffs, displace those imported tons. So you'd have more domestically produced steel, not necessarily higher prices. Like I said, I think it's just a slippery slope of you just tariff everything and then you make it in the U.S., but there's obviously inflationary consequences. We think that China then has its own response, right, of additional tariffs. And we think that people are probably overly bearish on implications for copper and aluminum there.
Well, some of the metals, particularly some of the stuff that was reported on today, I mean, I actually had to look up the names of some of these things because I never heard of them.
What, you don't talk about gallium?
Gallium, germanium, antimony. I was like, are these real things? But apparently they are, and I'm sure you've heard of them. But it gets to this idea, though, too, that something like steel and copper, if there is broader tariffs or some sort of walls coming down in that space, there are alternatives. For some of these materials we're talking about, there aren't a lot of places, at least that are actively being mined, that aren't necessarily under the control right now of China.
Yeah, we don't follow all the more obscure ones as much either, to be honest. I don't have the whole periodic table in our coverage. But at the same time, for example, rare earths, right? China dominates rare earths about 90%. But there are rare earths production that are evolving in the U.S. and they're still fairly high cost. But the design had been to deploy more tariffs once those were ramped up. Yeah, there was a plan there in place to replace imports with domestic supply, but sometimes you don't have it. You can't manufacture something that's not in the ground.
Yeah, there have been some efforts. I mean, I know particularly out in Nevada, I can't remember the name of the company that's been trying to do just that. There are some deposits, but of course environmental regulations and some other things kind of slows that down. Do you anticipate that maybe, given some of the rhetoric, the deregulation rhetoric we've heard from the incoming presidential administration, that maybe that could be a bit of a salvo for more exploration of these broader array of rare earths and other minerals and metals?
Yeah, I think that would be a positive. If you look at the copper miners and the other miners that we cover have definitely for years been bemoaning kind of the regulatory challenges to operating and how, we've been inviting and encouraging mining outside the U.S., but, we have quite a bit of resources still on the ground here that can be deployed. So I think that's going to be an evolution under the Trump administration as well. All
right. Timna Tamner's equity research analyst over at Wolfe Research. A closer look here at the latest salvos in the tariff trade wars, including a reiteration by the president-elect that he is opposed to a takeover of U.S. steel. When we come back, we're going to take a look at some of the movers on the day, and that includes shares of FedEx, which are really feeling the weight. A downgrade today. We're going to talk to the analysts behind that note. That's coming up next in our Top Call segment right here on Bloomberg. All right, let's get a view from the sell side. Top calls, big movers on the back of analyst recommendations. And we start off today with a look at Birkenstock. HSBC upgrading the shoemaker to buy. The analyst telling investors, chill out and don't subscribe at all to the idea that sales for the brand have peaked in any market. He says put more focus instead on the growth opportunities, including in Asia, where the company has less of a presence. Birkenstock shares up 2% on the day. Next up, let's take a look at two opposing views on Kroger. Jefferies upgrading the grocery chain to buy, but BMO Capital Markets cutting to market perform. BMO analyst Kelly Banya says valuation expansion would likely require stronger grocery market share, and that an EPS accretion from a no deal scenario with Albertsons is now largely reflected in the stock. The shares fractionally unchanged on the day. And finally, FedEx, a downgrade to market perform over at Bernstein as recent data checks call for investors to move to the sidelines. Those are the words of the analyst who sees challenges ahead, including the integration of FedEx's physical express and ground networks, as well as increased tariffs and trade restrictions that could hurt air freight volumes. Shares of FedEx taking a big leg down 4% on the day, and those are some of our top calls. We do want to stick with that last call on FedEx. Pleased to say that the analyst behind it, David Vernon, joins us right now. He's managing director and senior analyst over at Bernstein. And I do want to start off, David, with the situation when it comes to tariffs and some of these de minimis value rule changes, potential changes, I should say, and how that would have an effect on FedEx's freight volumes.
Sure, and thanks for having me. So there really are two distinct factors there. One being tariffs, which would be negative on aggregate demand for air freight and priority shipments. And the second is the changes in de minimis shipping rules, which are rules that are in place for lower value shipments to come into the U.S. without an export duty. So think Shein, Temu, lower cost e-commerce stuff coming out of China. If those rules change, you're going to have a big impact on air freight demand. Air freight demand has been one of the strongest parts of the freight ecosystem internationally the last maybe 3-4 years. We've seen continually reaching new highs in total aggregate tonnage. FedEx is the largest global air cargo and express airline. If we see the weight of tariffs take hold and de minimis shipping changes take hold, you're going to see volume move out of the air freight system. That's going to leave a hole in capacity. That's going to mean lower yields. That's going to have an indirect impact on pricing for some of the express shipments. And it's just not a great situation to be in if we see one of their best performing markets take a leg lower while they're in the midst of coming out of a U.S. freight recession ahead of all of the integration work they have to do with express.
Do the executives, do management, do they have a plan? Have they articulated a plan to maybe mitigate that risk?
I'm sure they're going to do everything they can to mitigate that risk. Normally in a situation like that, when cargo yields start to go lower, you can redeploy aircraft, you can move assets into different markets. Tariffs from China might be replaced with air freight from Vietnam would be something the company would tell you that they'd be able to move those planes into those markets and it would be okay. The problem is the aggregate volume of freight moving would come down. Mm-hmm. Other aircraft are also mobile, so you're going to see essentially supply-demand get a little bit out of kilter there for a bit, and that might take a while and take a hit out of the near-term earnings outlook.
The other part of why you saw some difficulty with the stock is execution, and that's FedEx integrating its express and ground delivery networks. How's that going? Like, when do you think we're going to get a good result from that?
So we're in the very early stages of the actual physical integration. The company's completed the integration of the overhead structures, so there's now kind of a one FedEx model in place over the small package business. The freight business is entirely separate, but the operating infrastructure, the ground networks, the courier networks, all of that work has still yet to be done for the most part. They've been working at it in smaller markets, say Kalispell, Montana. They've worked on Canada. They've worked on Hawaii. So they're approaching it from the edges, testing different various operating models in terms of trying to mix the time definite and day definite product across their company employees and their contract employees. They still haven't gotten into thinking about how to fix, say, Chicago or New York. Those are going to be much more complicated integrations. That's probably within a 2-year time frame. So we're still in the very early stages right now, and it's simply too early to say whether it's been a success or failure yet from a physical integration standpoint.
All right, David, we appreciate it. Thank you so very much. David Vernon over at Bernstein, taking a look at FedEx. That stock right around session lows, down by about 4% on that downgrade. We haven't seen this level since early November. Interesting because it's one of the worst performing stocks on the S&P, but really there's nothing to write that much home about.
Yeah, and this is a company that it's really got to get its sea legs back. I mean, it's a transition. It'll be okay, but it's going to take some time.
All right, coming up, a conversation with Joe Davis, Global Chief Economist at the Vanguard Group, about what lies ahead for the global economy in 2025. Oh, right, and it's Jobs Friday. This is Bloomberg.
Just about 3:30 p.m. in New York. This is the countdown to the close. I'm Romaine Bostick, your designated survivor, alongside Alex Steele.
There's context to that, but nah, it's too deep. It's too deep. All right, let's get to some of the Fed speak, because there was a lot today. Yeah. There's been a lot this week, and it feels like everyone from Williams to Waller to Kugler to Daly is trying to set up the idea of super data dependent. December still on the table in terms of a cut, but they really need to see that inflation continue to come down.
I'm intrigued by this because I feel like some of the commentary is a little bit too on the nose, and I'm not sure how much they're going to stand by it. I was really intrigued by the Mary Daly interview, which was on another network, Fox Business, but she kind of talked about this idea that there's still this need to recalibrate policy. But she also talked about this idea that she still thinks rates are coming down and that inflation is under control. And I don't know, I feel like they're saying a lot of things that are in conflict with each other, which I know is kind of what they do as Fed members. And ultimately, the only person I really want to hear from, I think, speaks tomorrow.
Yes, Mr. Powell. Yeah, and also the question becomes sort of the labor market. And Mary Daly in that same interview talking about how the labor market no longer is a source of inflation. My question is, though, for how long? If we change the immigration policy and we change the dynamic, Well, yeah.
Okay.
And is that going to be the case in the next 8 months? That's really the question. All right. Well, today's October JOLTS data surprises to the upside. Those openings increasing to 7.74 million, and that helps set the stage for Jobs Friday. Here with more is Joe Davis, Global Chief Economist and Head of Investment Strategy Group at the Vanguard Group. So does this blow out JOLTS mean blow out jobs?
Not necessarily, but
Okay.
I think it wasn't terribly surprising to me. So again, just take a step back. This is an economy that remains incredibly resilient. We've had pockets of slowdown, but we have GDP growth of 3%. So this notion of a soft landing, we're somewhat skeptical in terms of the interpretation. We have a strong aggregate demand, and so seeing that in the labor front, which has benefited from two positive supply forces this year, I think has produced a wonderful outcome. And we see some of that persistence into 2025.
So does that mean a strong or solid job market, and that is good or bad when it comes to the Fed? That they can keep easing policy, they're going to have to put their foot on the brake?
Well, again, I think there's two views. One is that we believe and have for some time the Federal Reserve is not as restrictive as they think, and this notion of recalibration. You mentioned recalibration. Roughly 4% is the neutral rate, plus or minus, and so they're restrictive, but not tremendously so. And so the trick then will be, can you navigate this? We've seen a normalization in the labor market. We're effectively balanced, and there's a number of reasons for this. Again, part of it due to migration. So if that momentum continues, at a fair pace, we're going to look for economic growth in 2025. It'll probably be a little bit stronger than expectations.
Why do you think people are so concerned, though? I mean, there are a lot of people, they look at the health of the labor market, but they're still concerned about, I guess, some deterioration. But we haven't seen it. But there's been some incremental layoffs that you typically tend to see at the end of the year. Nothing really out of the ordinary. Yet people seem to think there's something major happening.
Well, and again, I think part of this is this debate of how restrictive policy is. I mean, again, we've had 20 years of materially lower interest rates. And so if you've grown up in that environment, you think anything with a 5 handle is fairly restrictive from a policy sense. And I think that's where most of the Federal Reserve is. So I'm not saying they're not restrictive, but they're not as restrictive as we think. And we feel very confident about that. So, I'm not waiting for a shoe to drop. I mean, the wild cards will be, I think, away from the Fed this year, and it's more in the tariff and in the migration
And it gets to this idea, too, because you talk about that rate hiking cycle. And now what's been more than a year since they kind of started to kind of pause things and then start to cut. There's been a lot of time to parse the effects of those changes. And we haven't seen a tremendous amount of damage to the economy from that.
Well, and I think that the U.S. experience is really the root cause of why we've had U.S. exceptionalism in the financial markets. The general narrative has been the Federal Reserve kept rates high and then modestly lowered them a little bit to equate demand with a great outcome. It's the soft landing. We firmly believe that is the incomplete picture, that there was a supply element, and only with that, by moving out migration and productivity, do you have growth up and inflation down? That is the only way you explain U.S. exceptionalism and the fact that we have had a high on interest rates without this deterioration in the labor market.
You understand the economy. Does Jay Powell and the Fed deserve credit for that?
Well, I think they acknowledge the recent positive. I mean, Chairman Powell actually mentioned this explicitly in his last speech. We tried our own best this whole year to get a handle on this because the U.S. economy was the only economy that had restrictive interest rates, did not see some trade-off with some job losses and some lower GDP growth. And so the question is, why is that happening? Because if you can answer why, we believe we have some sense of what 2025 will bring in terms of the growth.
The one wild card, though, and you mentioned it, will be trade and immigration, right?
Yes.
If we wind up cracking down hard on immigration and even deport some illegal immigrants, does that sort of heat up the job market again and make it a lot tighter?
Well,
and does that sort of throw a wrench into all of this?
It could, but it's also again, I think that would be a tail event. There's also disruption because you have to understand the immigration is also boosting demand at the same time. Because for every new worker, they're also consumer. So again, I think you would have to see material changes. We are assuming some moderation in that regard. If we're along our baseline, then as long as growth holds up, that we're actually talking about a modestly tight labor market that still remains fairly tight in the 4% unemployment range this time next year.
So manageable along with inflation,
it's
hence
manageable.
A slow decline then in rate cuts. So then based on that, the reason why, in essence, growth has held up is in some part fiscal. Do you feel like the fiscal picture changes then?
Well, I think we're going to see an extension of policy, and so not see the sort of retraction in the tax cuts that we had from several years ago. So that's in one sense, it's not tremendously stimulative. Structural deficits are positively boost growth, but it's not material. So I think that's more of a push. In 2025, the tariff headwinds would be a clear negative on the growth and in the inflation side. I think the productivity is probably going to stick for a little bit in 2025. So net, this pushes you modestly upside risk on growth, and inflation is probably probably steady as she goes. This tells me the Federal Reserve is not going to have to cut rates as aggressive as they think. I think we're starting to see that accepted in the bond market.
I am curious. So, okay, American exceptionalism, that's the story here. I do want to pivot to overseas, and let's start with Europe, because it's anything but exceptionalism over there. Obviously, Germany reeling. Who knows what's going to happen with the French government over the next 24, 48 hours here. How do you factor that into your global sort of economic forecast when you have so many countries, and not just in Europe, but even in Asia, that are still struggling?
Sure. Well, again, you have to look at the linkages across two main vectors, and one is around trade, and clearly. The other one is around profitability of companies and where that investment in the financial system. And when you do that, the Europe has never really had a strong feedback on U.S. growth. There was a time where China has some, because of the supply chain, but it's really U.S. driving the rest of the world. China for some time, came as a second, engine in terms of that. But the rest of the world follows the lead of the U.S. rather than vice versa.
And this gets to the other issue of the situation that I'm sure you haven't had a whole time to parse that's going on in South Korea. I know that the economic implications aren't huge for the U.S., but it is still a significant trading partner. And obviously, geopolitically, it's an important ally here. Who knows what the government's going to look like over the next few days and weeks. They had martial law. They pulled it off here. Is that a potential risk that investors should be looking at, the economic risk coming out of
Well, I would actually zoom out, maybe where you were going, Romain. Yes, economic risk, but there's broader, I'll call it geopolitical risk. Now, that sounds like something I'm being vague. I'm not. I'm intentionally just saying the market has two themes pushing at each other financially this year, and that is powerful momentum. We see this U.S. equities. Valuations are stretched. And so anything where geopolitical risk can push you in one way or the other. Last year, it was a very positive one. I would hope that would be still the case, but the market's vulnerable. I'm not intentionally be bearish, but I do worry when you have valuations this stretched that it's unlikely to continue for the all the way out the horizon.
All right, Joe, going to have to leave it there. Great stuff as always. Joe Davis, one of the smartest people in the business, global chief economist for the Vanguard Group. And we were just talking about the situation in South Korea. We're going to take a closer look at what has been an incredibly wild day over there. 5:38 a.m. in Seoul right now. And who's in charge of the government? Not quite sure, but investors have reacted. It's coming up in our stock of the hour right here on Bloomberg. An incredibly wild day in South Korea, a president declaring martial law and then rescinding that order. A lot of questions about the future of that country, the future of its leadership, and the future of its economy. A lot of this unfolded while Korean markets were actually closed. But here in the U.S., you did see a lot of market activity, including in the iShares MSCI South Korea Index, the EWY down 2%. It is our stock of the hour. And Abigail Doolittle joins us right now to talk a little bit more about this. We saw a lot of interesting reactions in the market from the main ETF, the tracks South Korean stocks, and some of the individual ADRs, and of course with the currency, the won versus the dollar as well.
So today really maps out as a classic headline risk day. We had these headlines earlier today, of course, that President Yoon, South Korea, is installing this martial law essentially because he thinks that the opposition party is going to impinge upon his administration. This seems pretty non-democratic. Some are even calling it anti-democratic. There's some in South Korea saying that it is dictatorship-like. It'll be interesting to see whether in hindsight in the West it's called autocratic. But anyway, you slice and dice it, a ton of uncertainty. So understandably, we saw this massive sell-off. At the lows, these South Korean ETFs down 7%, the worst day since March of 2020. The South Korean won down 4%, the worst day since March of 2020. So that was the degree of selling power. Wow. Now, one thing I would say is when we have headline risk events like this, typically what happens is more information is had and then the initial knee-jerk reaction reverses. That is what we're seeing to some degree here. A counter example would be the pandemic. It just got worse and worse. The GFC, it just just got worse and worse. Here, though, it's interesting because we don't know. It seems as though the tensions could ratchet up between these two parties. And of course, President Yoon is saying that the Democratic opposition party is somehow aligned with North Korea. We also have others saying that this action on his part is China-like. So when you put all of that together, you were talking with your last guest about the trade implications between the U.S. and South Korea. We don't know, but electronics, integrated circuits, cars, and then just also the volatility. I would say the thing that volatility brings. Music.
Yeah.
Really? Okay.
I must be unaware of that music.
You should have seen the look Alex did.
Aside from K-pop, it's also interesting, too, because a lot of analysts are saying, like, look, he's probably going to face impeachment, too. So it's definitely not over, which is also why it's interesting that we're off the lows when it comes to the ETFs. Now, if you look at a 1 week forward volatility for the won, for example, it's still elevated, but you have to wonder how long it stays elevated.
It probably, based on a longer term chart of the won, it probably stays elevated for a longer period of time. The trend over the last year is straight up, the dollar gaining against the won. So that it's interesting around the forward volatility that you're talking about. What may be happening there, just a little bit of a relief that, order has been restored. Parliament did vote to have the lockdown taken away. President Yoon saying he's conceding to that. But yes, more uncertainty ahead. That's going to mean volatility in the markets. A lot of geopolitical volatility around the world right now, clearly. That's the understatement of the year.
Yeah.
But this is one more piece, and surprising, too.
Yeah, and we should point out to Alex, the latest headlines out of Yonhap News is that the South Korean opposition party now calling on Yoon to step down. I think they were calling for him to step down before this, but certainly reiterating that.
Yeah, and like we mentioned, it's sort of waiting for any signs of impeachment there as well. All right, Abigail, thanks a lot. Really appreciate it. Bloomberg's Abigail Doolittle joining us there, taking a look at those South Korean ETFs. Off the lows of the session, but still lower on the day. We are 15 minutes away from the closing bell. Next up, Leo Kelly is founder and CEO of Verdence Capital Advisors. We're going to break down what he's thinking. Are we going to still see tech continue to lead this way higher and outperform, or do you need to look again at some of the underperformers like small caps? This is The Close on Bloomberg.
When we think about tech overall, yes, the PEs are high, the multiples are high, but when you look at the margin expansion that we've seen in the S&P over most of the last 10 years, the vast majority of it has come from the tech sector. That helps a lot, but we do think you're also going to see some rotation.
Sinead Colton-Grant over at BNY Mellon kicking us off to the close just about 50 minutes ago. Romaine Bostick alongside Alex Steele. Modest gains in the market and really confined to just a couple of indices, primarily the NASDAQ. And the S&P, though, poking back into the green. Look at that.
I think we're going to close at a record high. It's going to be the 55th record high. We're just about 3 points away to the upside, so we could eke it out there. But under the hood, it's the real economy cyclical stocks that are getting hurt. And it's really the Mag 7. It's not even tech. It's really the Mag 7 that are holding up. Yeah, and it's kind of interesting. I was taking a look earlier. You got Meta at a record high, Apple at a record high. I think Amazon was at an intraday record high, though not quite holding on to those gains. And it raises the question whether people are piling back into those names because they generate a lot of cash flow and they're great bets, or are they piling back into those names because they're fearful of something else, and this is the safety trade. I love that question. Is it actually the safety trade, or is it something fundamental, or are we just book squaring at this point to the end of the year? Well, let's pose that question to our next guest as we count you down to the closing bells. Just about 8.5 minutes to go. Leo Kelly joins us right now. He's the founder and CEO at Verdence Capital Advisors. And I don't know if you heard the discussion Alex and I were having, but I do kind of wonder that on days like this where we do see the Mag 7 and big tech kind of become the only trade in town, whether that's a sign of bullishness or whether that's more a sign of skittishness in the market.
Well, I think the real sign of bullishness has been the broadening of the market over the last month since the election. We had a great November, obviously. We saw the S&P 500 equal weight do very well relative to the S&P 500. Small caps had a great rally in November. So I do think, today's trading aside, the broadening of the market is more bullish. When you get the leaders that have such a spectacular run that the Mag 7 have had, when they start moving on their own, that's less bullish. That means the market's grasping on to a last straw. But I'm more optimistic given the last month of trading relative to today.
I am curious, when you look at the market in aggregate, let's just take the S&P as the benchmark here, sitting at record highs, potentially another one today, and a lot of questions as to how much further this rally can go. I've seen some pretty bullish estimates for 2025 suggesting double-digit gains again, percentage gains for the S&P.
Yeah, I start to get nervous when the whole world starts to fall into one camp, and we're starting to fall into this super bullish who can set the highest estimate for next year. It's almost like the analyst community is afraid to miss on the low side. And for me, that says we might be getting a little over optimistic. We've had one heck of a year this year. We've had a really good November. Seasonally, we're moving the way we should. But I do think as we start to get to more stretched out valuations, as we start to look at next year, which the first year of a presidential campaign is usually not the best of the 4 years. There's some seasonality here. I think we are overdue for some volatility. This market is heated, and I think it could use a bit of a breather. And I think we'll see it in first quarter.
Okay, Leo, so what does that breather look like? Like, do you sell into that? Or are you just kind of waiting and seeing, holding, not doing much?
Well, interestingly, we've been neutral to slightly overweight equity throughout this process. We have rotated out of that big Mag 7 S&P top-end growth trade. We had been moving into small caps, moving in international stocks, which look very inexpensive, moving into more value sectors. And I think that trade holds for some time. This is starting to look a little bit like 99, 98, 99 again. But there's a place to make money in the market. But I do think we'll see volatility. We do have excess cash. That excess cash comes in lieu of long bonds. So we do have dry powder ready to go for volatility. We would buy into volatility, but we're not going to chase the same old trade as the answer.
Leo, you're the second person today that's talked about the 90s and how this is reminiscent, where you can still have valuations go up and the markets go up. You still have a little bit high inflation. You still have a Fed that's holding rates a little bit higher, but everything seems to be relatively okay. Does that make you nervous that I'm telling you that somebody else said the exact same thing to me earlier today?
Yeah, I think we're a little less bullish on the whole inflation case and the bond case. I think the Fed has done a really wonderful job of dancing this fine line between lowering rates and easing up the rate situation and battling back inflation. But they really have a tenuous job. Money supply is massive. It grew by 40% in 2 years. I've said this over and over. That's third world country stuff. And so every time the Fed just eases off the pedal just a little bit, we're going to see inflation come back and come back very quickly. We already have seen a couple hot reads here in the last month. So I don't think anyone who's waiting for the Fed to keep dropping rates and we're going to have this help from the Fed that we've had in the past, I think that's that's not going to play out. I think every time the Fed eases back, inflation will push them back to a more conservative stance. So I do think you have to be active. I think you have to look at valuations. I don't think that the easy trade of just buy these big tech names and they go up indefinitely works forever. And I think that's really where we look more at the 90s. The percentage of the S&P that the Mag 7 represents, the valuations, the trade. I know people say, well, it's different this time because AI is so big and these are good companies, but so was Cisco and so was Microsoft. I'm not saying don't own them. I'm saying be real careful with them and broaden out the portfolio to these other sectors. That's just smart investing.
And when you talk about this broadening out, and we've seen that, Leo, I think a lot of people are probably more in your camp than maybe they want to admit publicly if you just look at the price action. The price action doesn't lie. You've seen that rotation. Right. It may be gingerly, but certainly people are doing it. I am curious, though, if you assume that maybe we don't get any real help from the Fed and economic conditions at least stay more or less where they are right now, can you make a strong case for some of those riskier names that maybe were on the back foot? I'm talking about equity names that were on the back foot because of concerns about debt levels and cash flow and things like that, et cetera.
Yeah, Romaine, I think you're talking about some long-term issues that have to be addressed, right? The debt is finally reaching a point where the interest rate carry cost is leading us down the path of, dare I say, austerity. And those are big picture, long-term trend trades that I think we have to be very mindful of. And that's why you have to be active in your portfolios. I think if the Fed is successful and really knocks out inflation, we're going to have to be at or close to or in recession. and that's going to create volatility. But volatility isn't necessarily bad. Volatility gives you the opportunity to buy into assets that were formerly overpriced. So I think you just have to be mindful, keep some dry powder, look for volatility, and be aggressive in that volatility. What's coming on the other side of all of this, I think, is a long-term bull trend that I think will be good for investors.
All right, Leo, always wonderful to talk to you. Leo Kelly is the founder and CEO of Verdence Capital Advisors, helping us count you down to those closing bells with the S&P clinging to fractional gains. The S&P now at 60.50.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here along with Alex Steele, taking you through the closing bell. A global simulcast starts right now, Carol Massar.
Are you sure?
I don't know. I'm not sure. I'm never sure about anything, Carol Massar. What I am sure about here is that Scarlet Fu joins us in the TV studio as she does every day at this time. Tim Senovic joins us in the radio booth every day at this time. Carol Massar, it's always a wild card whether she's going to be here or not, but we still welcome our audiences across all of our Bloomberg platforms here on a record day for the S&P and the NASDAQ.
Unbelievable. It feels like it's been a painful trade, right? Like, I don't know. I want to hear what Jay Powell has to say tomorrow. I want to see what the jobs report. We're kind of getting back to some of the fundamentals and policy. That's kind of what I'm looking forward to at this point.
That's kind of all there is now that earnings are, we're kind of done with earnings. I don't want to say we're completely done because we never are.
Maybe a few more today, yeah.
We do. We talked to Stuart Paul, who's a lot more optimistic about the October and about the November labor numbers than payroll numbers than we saw in October because of the strikes being over, people being rehired after the hurricane. He's thinking 175,000 people.
Well, we'll see, because, of course, October was pretty messy because of all the weather events. I don't know about you guys, but I was fascinated by the drama that took place in South Korea, where there was martial law for almost 6 hours until they lifted it. And that kind of sets us up for tomorrow, where there's going to be drama in France, too.
Yeah, and sort of how do you wind up pricing that, right? Like, you could some of the iShares ETFs that track South Korean equities, you definitely saw them low, but they're closing well off the lows of the session as we're looking at, again, record highs for the S&P 55, if you're keeping count, and the NASDAQ 100. And
it raises the whole question here about why you're not seeing a little bit more downside hedging here in the U.S. And really, we should point out globally, because when we talk about the record highs, a potential 55th record high here on the S&P 500, you have the MSCI All-World Index also closing at a record high today, of course, propelled in big part by U.S. exceptionalism, a big part by the Mag 7, 60, 49 and change. It takes a while for these numbers to settle. The S&P 500 is now up a fraction of 0.1% on the day, but that is going to be good enough for a record high should that hold. The NASDAQ also at a record high, up about 77 points or 0.4%. The Dow Jones and the Russell sitting this one out. The Dow Jones Industrial Average down about 0.2%, while the Russell 2000 closing out the day down 0.7%.
All right, and if you go deeper into the S&P 500, you can see that most names in the index actually lower in today's session. Looking forward to seeing the IMAP. But Scarlett, we've got about 348 names in the S&P 500, lower today, 153 to the upside.
Yeah, 8 out of 11 sectors in the red: utilities, financials, and industrials leading the declines. The 3 sectors that are in the green are, the techie sectors: communication services, tech itself, and consumer discretionary.
All right, so let's get to some of the individual gainers, guys. First of all, old time, AT&T. This name was among your top gainers.
Sorry, can I just interrupt you?
Yes,
expecting
please.
Earnings out of Salesforce. Those numbers now just crossing the wire as we speak. Let's get right to it. Sales in the most recent quarter, it looks like a beat, $2.12 billion. The street was looking for $2.06. Services revenue also a beat at $2.29 billion. Overall revenue coming in at about $9.44. That's also a beat here. Not quite seeing the EPS numbers just yet here, but at least on the top line certainly looks like a beat, guys. Here's your forecast, your fourth quarter revenue forecast. The company providing a range of $9.9 to $10.1 billion. Street was looking for roughly about 10.1, so the top end of that range pretty much in line with the average of Street estimates.
All right, little movement to the downside on Salesforce, just down about 1%. Check this one out. Let's bring up the aftermarket and Okta, because it is soaring in the aftermarket. This is the mobile identification, security, multi-factor authentication company coming out with its numbers. Let's go right to the outlook. Fourth quarter revenue, they're looking at $6 $667 million to $669 million. That's above the street estimate of $650.7 million. Fourth quarter adjusted EPS, they're looking for a range of 73 to 74. Not really quite a range, but well above the estimate, which is 67 cents on the street. And again, they're looking for fiscal year revenue of $2.6 billion. They had seen 2.56 to 2.57, so upping that up just a little bit. And that stock up 17% in the aftermarket. It had been down about 10% here in 2024. But if that holds into tomorrow's session, we'll see that stock move into positive territory for 2024.
Well, quite a move from Okta right now, higher by 16%. Salesforce not moving much. I'm just looking through the press release right now to get some commentary from Mark Benioff, chair and CEO over at Salesforce, talking, of course, about AI and Agentforce, the complete AI system for enterprises that is built into the Salesforce platform. He says that, quote, the rise of autonomous AI agents is revolutionizing global labor, reshaping how industries operate and scale. And with Agentforce, we're not just witnessing the future, we're leading it, unleashing a new era of digital labor for every business and every industry. That's a quote from Mark Benioff in the press release. I'm still waiting to see what that actually looks like and how companies are able to save money and become more efficient with use of AI. I think a lot of investors are as well. Salesforce right now, up about 0.7%.
And we have a little more detail on Salesforce's outlook, too. Fourth quarter adjusted EPS will be $2.57 to $2.62. That is lower than the consensus estimate of $2.65. And of course, this is a stock that has climbed 27% since its last quarterly earnings. So it's got quite a bit priced into it on that excitement over those AI agents. We also have some headlines on Campbell's, the soup company, or the once upon a time Just Soup company. It has boosted its quarterly dividend by about 5%, and it also reported results. First quarter adjusted EPS 89 cents, beating the consensus estimate by 2 cents. Net sales $2.77 billion does fall short of the analyst estimate of $2.8 billion. For the full year, it sees net sales of 9% to 11%, which looks to be a maintenance, reiterating its forecast for what it saw for full year sales.
All right, we're also waiting for Marvell Technologies. That should come out any moment as well. Again, looking at the AI read-through from there. Going back to Salesforce for a moment, because I wanted to look at that forecast in terms of the fourth quarter. It's looking at revenue estimates anywhere from 9.9 to 10.10 billion. That looks like a beat from what current estimates were. Adjusted earnings estimate coming in at $2.57 to $2.62. That's a little bit lighter than what's estimated, but that stock now reflecting that upside over 4% and 3%, because a lot of these numbers look super, super solid.
And it's kind of interesting, too, when you talk about the contribution from AI on the total revenue stack, and they don't really sort of explicitly break that down, but you can see that sort of reflected in the subscription and support revenue. Definitely a little bit of a boost, and you talk about this whole, AI, agent thing that they're trying to roll out here. And this general idea that when we look at sort of the big upswing that we've seen in AI-related stock, it has been confined to chip makers like NVIDIA. It's been confined to cloud computing companies like Microsoft. The big question is this the time now where investors embrace the software side of this story?
All right, guys, Marvell Technology also out with its earnings. Third quarter adjusted EPS, 43 cents. That's 2 pennies better than the street was expecting. Third quarter loss per share, 78 cents versus a loss share year over year of 19 cents. So we'll look for some clarity around that. Marvell Technology up 7%. So investors seem to like what they're hearing initially on these brief headlines. Third quarter net revenue, $1.52 billion. That too was better than what the street was forecasting. The street was looking for about $1.45 billion. And here's something into the outlook. Marvell Technology sees fourth quarter adjusted EPS of 54 to 64 cents. And folks, that's above the street estimate of 52 cents. So yeah, that stock's up 10% here in the aftermarket.
Matt Murphy, the chairman and CEO of Marvell, saying that the exceptional performance in the third quarter is primarily driven by our custom AI silicon programs, which are now in volume production, further augmented by robust ongoing demand from cloud customers for our market-leading interconnect products. I bring up his name because he's one of the names that could potentially be a new CEO over at Intel. Our Bloomberg News team reporting a little earlier today that the search for a new Intel CEO is focusing on outsiders. And Matt Murphy over at Marvell, one of the names that is being floated. Shares up 10% now.
And of course, investors continue to search for opportunities in the AI and in the tech space. And of course, that includes names like Amazon. Amazon Web Services right now is hosting its annual reInvent conference. this week to discuss their latest innovations. And the AWS CEO, I'm pleased to say, he actually joins us right now. Bloomberg Technology co-host Caroline Hyde standing by. Caroline, take it away.
It is a joy to be joined by Matt. Thank you, Romain. Matt, welcome from Las Vegas. Reinvent upon you. Chip ultra clusters, ultra servers, chip development, LLM. Then we've got talk about developer tools. There's a lot to get through. Let's start with the ultra cluster. Can you just talk to us a little bit about this more than 100,000 chips that will be put in one single area for AI hardware? Why do it? What will it offer?
Yeah, this is something that we're building together with our partners in Anthropic, and it's actually going to be several 100,000 chips. And they're focused on, and it's our new Trainium 2 chips. And so we expect that this should deliver them 5 times more compute than they've used in their last model training. And so we're really excited about what they're able to accomplish. And they're expecting to build much bigger and much more capable AI models from that large compute cluster.
Do we have a US location? Do we have an exact time frame other than early 2025?
No location to share with.
Matt, what then of the technical challenges? Paint the picture for our audience, how difficult this is in terms of cooling, in terms of energy use. What has been the things that you have to overcome with this?
Yeah, well, the first core innovation is that we built our own chip, actually. And so we've built our own chip. It's called Trainium 2. And we're quite excited about the performance that we get out of that. And that's combined all in these really large ultra clusters that combine 64 Trainium chips, all to deliver 83 petaflops from a single node. And so that is the first innovation, is our Amazon-designed custom silicon that gives us really unparalleled performance for generative AI capabilities. And then we build these together with high-performance networking that we also build in-house. And then, of course, there'll be cooling and heating and power that we need to go build the data centers. But it really starts with that silicon down at the level. And we innovate on the entire stack of AI to make sure that we can control everything that goes into those clusters.
Can you talk to us a little bit, compare and contrast here? This is about less dependency on NVIDIA GPUs to many ways, doing an alternative for your clients. What sort of cost saving will clients get? What sort of energy and efficiency will they get?
Yeah, well, first of all, I think we like to think of it as a supplement to NVIDIA GPUs. NVIDIA has a fantastic product. That team has done an outstanding job executing. And we think that the vast majority of workloads are going to continue to run in NVIDIA processors for a long time. But customers want choice, and they want choice that can give them some lower cost options. And we think that for certain workloads, for many workloads, Trainium 2 can give customers 30 to 40% cost performance benefits over today's GPU-powered instances. And so we think that that's a huge win for customers, particularly as they're looking to lower the cost of generative AI workloads. But we'll be great partners with NVIDIA and continue to lean in on building great technologies together with them for a long time.
Trainium 2 available, Trainium 3 in the works, and all of this is, as NVIDIA at the moment, it's estimated, has about 95% market share. Do you agree with that sort of number they have, and what sort of area do you think that will come down to?
Yeah, I mean, I think it's probably higher than that. I think the vast majority of workloads in generative AI today run on NVIDIA technology. And they've absolutely been the leaders in that space. But we do think we hear from customers that they want choice. And just with our processors, where we're tight partners with Intel and with AMD, but we decided to go build a general purpose processor called Graviton, and it's been hugely successful with our customers. But we also provide lots of Intel and lots of AMD processors in our cloud today, and those businesses continue to grow. So I expect that our usage of NVIDIA will continue to grow from our customers, and that choice is really going to be powerful. And as you see this explosion of generative AI usage, I think there's going to be plenty of business for multiple different people to be successful.
A key partner is Intel. How concerned have you been about the change at the top?
Oh, it's okay. I wish Pat the best. I know Pat, and he's been a good partner of ours. But we've been partners with Intel for a long time. It's been 18 years since we launched our first Intel instance when AWS and EC2 first launched. And we'll continue to be great partners with Intel, and they have a great technology team there. And we look forward to continuing to roll out the latest technologies from Intel for our customers to be able to use.
And you've been continuing to roll out, as you say, NVIDIA offerings. Last time you were on, we were talking about Blackwell, of course. Many have been frustrated, perhaps by some slowness to market there. When do you anticipate that Blackwell will be unfolding, and how difficult has it been to ensure the supply side is there?
Well, they've obviously had some manufacturing things that they're going through, but we're very excited about it. I think the early returns and the early looks at Blackwell look fantastic. We expect almost a 2.5 times gain in the compute power that you get from Blackwell that we saw from H100s. And so I think it'll be a really material jump for customers once we get those out. And I think those will be early next year. And we're excited about putting them in customers' hands. And we'll get them out there as soon as they're available.
Investors, though, they find it wild, this whole frenemy existence that's going on. You truly think that investors here think, oh, we want to see NVIDIA dependency as well as AWS having its own offerings? Is that something you think everyone can swallow, or do you think ultimately there will be a broadening out other than just NVIDIA winning all?
I do think it's a partner. Like, if you think about AWS, we started from the very beginning thinking about this partnership mindset. And we built the entire business around AWS, thinking about how AWS would have services and our partners would have services, and that there's plenty of space for all of us to really grow and build our businesses. And that is true for software providers. It's true for service providers, and it's true for technology providers. And so I think that we've proven time and time again over the last 18 years that AWS can have products and our partners can have products. And then as we make them all available, that the whole pie gets bigger. And so I think there's plenty of opportunity for both. And so it really isn't. I think it makes for a fun narrative that it's either or. But we're great partners with NVIDIA. We will continue to be. And this is all about making the pie get bigger.
We love fun narratives, us journalists. Talk about that pie when it's to do with large language models. You are unveiling Nova. You are really saying that the Nova offering compares really well to other offerings out there when it comes to multimodal, but also from a cost perspective and efficiency perspective. Why invest so much in LLM provisions when you already offer the rest?
Yeah, and again, this is all about giving customers more choice. I think we, as Amazon, were investing in these models because we couldn't find the exact right mix of capabilities and customizations and things that we needed internally. So we started building them. And as we started building these, we saw that these models were actually getting quite good. The benchmarks were really good, and we were seeing some good capabilities come out of there. And our models are quite good at some particular areas. They're very good at executing agentic workflows. They're really good at pulling knowledge out of a RAG index. They're very, very low latency and low cost. And so we think that capability is going to be really compelling for a lot of use cases. We found use cases inside of Amazon, but even inside of Amazon, we use a mix of different models. We use models from Anthropic. We use models from Meta and Llama. We use models from a bunch of different sources. And so I think that hopefully customers see a lot of value from these new Nova models, but we also expect that customers are going to combine lots of different models in lots of different ways.
You haven't yet got the access to OpenAI, and for obvious reasons with their relationship with Microsoft, but do you think that will at some point unfold?
Look, I think my view is anytime customers demand something that eventually that sorts its way out. And I think OpenAI obviously has a great set of models as well. And I'm sure many of our customers would love to have those available in Bedrock as well. And we'd love to support those there. I think I'd look at, and we have a long-term view on this. And over the long term, we'd like to make every technology available inside of Amazon and inside of AWS to use. And that means all of the models that are out there, we'd love to offer them in Bedrock. All of the software that's out there, we'd love to offer and make sure that it's available inside of AWS. Every service that everyone else and third parties are providing, we want to make available. And that all goes back to that choice story. And so in the fullness of time, I believe that we would love OpenAI models inside of AWS. Absolutely. It's we listen to our customers, and if that's something that customers want, we're absolutely game. Obviously, with a partnership, it takes multiple sources, and there's probably some complexities in there, as you allude to. But I think in the fullness of time, it likely is the case.
In the here and now, you spelled out on the previous earnings that AI is already a multi-billion-dollar business, growing at more than 100%. Can you give us any more detailed numbers as to how large the AI offering is for AWS now?
Yeah, you're right. It is a multi-billion-dollar business for us, and it's really growing rapidly. Take Bedrock, which is our platform that lots of customers are building all of their production AI applications on top of. Bedrock has grown the number of users 5x in the last year alone. So it is really a rocket ship growth of people building this. And I think what's really exciting is that people are using Bedrock not just to do proof of concepts, but they're using it to really deeply integrate with their own enterprise data and to launch production applications, which I think is a particularly telling sign of where the technology is going and where it's evolved to.
And clients willing to spend at a time of a lot of uncertainty. Look, we've got a new administration coming in. Do you see any concerns in terms of, geopolitics, your own supply chain, relationship with TSMC, for example?
No, I mean, I think, look, we've worked with various administrations all throughout the last 18 years that AWS has been around, and we're really excited to work with this administration. I think that everybody is interested in ensuring that we have technology continuity, and there's a ton of opportunity here. Like this is how we drive the economy, and I think all administrations are interested in continuing to make sure that we're able to drive the economy forward. And AWS is a big enabler of that. And so we're excited to work with the new administration. I think we're obviously anxiously watch all of the geopolitical events all around the world to make sure that we're trying to insulate our customers as much as possible from any eventuality. But I think we're cautiously optimistic that we're in a good spot.
You might have been cautiously watching what was happening in South Korea today amid your own event. Any exposure there, Matt?
Sorry, I missed that. I was on stage. So I moved from stage right here to talk to you. So.
Okay, understood. But in terms of the South Korean political destabilization, nothing that was a worry there?
No, I mean, look, we have a region in South Korea, and we have many of our customers that operate in South Korea, and we'll continue to support them and operate with whichever government is in operation.
We thank you so much for your time rushing off a stage. AWS CEO Matt Garman. Scarlett.
All right, thank you so much. Bloomberg Technology co-host Caroline Hyde speaking with the CEO of AWS. We want to bring you some breaking news that has just crossed the wire. Prudential Financial, the insurance company, naming a new CEO, making some changes at the very top. Andy Sullivan will succeed Charlie Lowrey as CEO at the end of March. Lowrey will stay on. He'll remain as executive chairman for about a year and a half after Sullivan takes over. There's also a departure from the board. Vice Chair Robert Falzon will take leave of the board and then retire in July. Sullivan plans to focus on growing the company's insurance and retirement business and also expanding its asset management capabilities.
Meanwhile, we keep an eye here on the after hours trade. 3 straight days of a resurgence here in the tech trade, and the top gainers right now in the post market, all in the tech space. Marvell Technology, of course, the chip maker, 7% revenue growth in the most recent quarter. That was above analyst estimates. And more importantly here, a Q4 forecast coming in above analyst estimates. Okta, the application software company, also posting earnings that rose from a year ago, more than analysts expected. Similar story on the revenue side, and a forecast that's also coming in slightly above analyst estimates. And then, of course, the granddaddy on your screen, that is Salesforce, the customer relations software company, making a promise here that AI is going to be a much bigger contributor to its bottom line. That did not show up in the most recent quarter. A slight miss on EPS, a beat on revenue, and minor tweaks to its forecast. A conversation coming up after the break with Anurag Rana over at Bloomberg Intelligence about what we learned this quarter and what to expect in the quarters ahead. This is The Close on Bloomberg.
It's Jobs Day, and Bloomberg has the report under surveillance.
Who do you think holds the leverage right now? Employers or employees? It's more balanced than we've ever seen.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
The labor market weakness we saw in the summer was a head fake.
What raises this question, basically, has the narrative been set?
We are still in the throes of a strong labor market.
The November Jobs Report, Friday on Bloomberg.
We are keeping an eye on shares of Salesforce, which are rising in after-hours trade after it reported quarterly revenue that topped analyst estimates. And of course, there's a lot of hopes pinned on its AI products and what it means for the company going forward. Let's bring in Anurag Rana of Bloomberg Intelligence to give us more context on what we're hearing from the company. So, Anurag, Salesforce has this new AI product, AI agent strategy. It was launched in October. There's obviously going to be a transition period before it really starts to contribute meaningfully to its revenue and to its bottom line. How long are we talking about here, and how much runway will investors give the company?
I think we should not see any major lift, at least for the next 12 months or so. After that, we should see an increase in adoption throughout its entire product suite. And I think that's what everybody is waiting for. You know, when you look at results today, it's really the margin that stood out. Everything else was generally in line. So I think that's really the story at this point, but I think it will translate into greater contribution from Agentforce down the road.
Do we learn anything, I know, just from the release, and maybe we'll learn a little bit more on the call, Anurag, about the adoption, the take-up of these new products, and just how much existing customers are embracing them, and more importantly, whether new clients might actually be brought into the fold because of this?
See, Romain, it's just been released for a little over a month in terms of it's just, so I think this is more in the experiment phase. I think on the conference call, they're going to share a lot more examples of what kind of customers are embracing it, what kind of results they are seeing. I think that's really the key at this point. But as I said, the good thing for us was that things are not getting worse when it comes to some of the other metrics. But at the same time, almost everything else came in line, apart from the margin, as I said, which was above expectations.
The margin was above expectations, but the company is going to be spending a lot in the next couple of years. Mark Benioff said that they're going to hire about 1,000 employees to sell this new product. And this follows almost 2 years of cost cuts at the company, pushed in part by activist investors. Is that something investors are going to be willing to be patient through?
Yeah, I think that's a very small headcount increase given the size of the company, frankly. When you look at the amount of money they spend on sales and marketing as a percentage of sales, it's still very high compared to mature software companies. So they really have a long way to go before I would call their cost structure optimized. If they grow, let's say next year around 8 to 9%, then they have the money to afford to invest in headcount growth like this.
Of course, I have to ask you the question, Anurag. Anytime we talk about growth for a company like Salesforce, or I should say a growth for a company owned by Mark Benioff, is acquisitions, is M&A going to be a part of that? I know he says not, but what do you think?
Yeah, I think, at one point they did say that they're not going to be any large acquisitions. And, you should expect smaller ones out there. But, I would confess that we were a bit surprised lately. There was some chatter about them acquiring a little bit larger company. And I hope they don't do that and mess up the organic margin improvement story. I think that's really resonating well with investors in terms of the free cash flow that they're showcasing. And if this Agentforce thing takes off, then their top side is going to, or the top line is going to grow as well, along with margin expansion. And I think that would resonate even more.
Anurag, what will you be listening for on the conference call, and what are they likely to actually disclose?
Yeah, I think the use cases of Agentforce is what we will be listening to the most in terms of what kind of experimentation is happening with clients and what kind of benefits they're getting. Other thing is their pricing mechanism for this Agentforce is very unique, which is on a per transaction basis or a per conversation basis. I think they should give a little more background as to what how they are going to monetize some of these products, because they are not priced on a per user basis or a per headcount basis, but more so on a per conversation basis.
All right, Anurag, always great insights, and we always appreciate you jumping on as soon as these earnings come out. Anurag Rana over at Bloomberg Intelligence, he'll be tapping into that call. The shares higher in after hours, trading by about 5%. I was just taking a look. I forgot that this was a stock that doubled last year. It's only up about 25, and I say only up about 25% this year. But it gets to the idea is, where is that sort of mega growth story that I think Salesforce investors have been used to?
Yeah, and it's an example of how the AI hype has moved from hardware and chips to the software companies and how they can deploy it.
Absolutely. All right, when we come back, we're going to take a look back in history at the hype and mystery surrounding the introduction of the Segway. Remember the Segway, Scarlet Fu?
Didn't a president write on that?
A question before we go to break. How many of the original Segways were sold during its 19-year history?
3 digits? 4 digits?
The answer when we come back. This is The Close on Bloomberg. All right, here we go. A quick look back in history. December 3rd, 2001. That was when inventor Dean Kamen unveiled the worst kept secret in tech innovation, the Segway. The two-wheeled upright self-balancing scooter had been the subject of rumors for months. This was after the website Inside.com reported that a journalist had been paid $250,000 for a book about a top-secret personal mobility project dubbed Ginger, or IT. Other news outlets picked up on the story, and well, let's just say things got a bit out of hand. The book proposal quoted luminaries like Steve Jobs, saying Ginger would redefine city planning. Venture capitalist John Doerr comparing its significance to the internet, and Jeff Bezos apparently giving a loud honking laugh when the unit was turned on. But nobody saw this thing. So like a lot of the hype, there was a muddling of truth and hope. Cayman indeed was granted a U.S. patent back in 1999 for an individual transport vehicle that uses computers to keep itself upright. Now, for months, the chatter centered around that rudimentary sketch of the device on the patent application. Who is Ginger? Who is it? Well, finally, we learned. A splashy debut on Good Morning America, Cayman pulled the curtain off the Segway and then headed to a nearby park in Midtown, New York, where the news anchors just rolled around in circles for a few minutes. It was a revolutionary device, to be sure, but it ended up being a revolutionary disappointment. The original models had speeds of only up to 10 miles per hour and a range of less than that before the battery died. And a $5,000 price tag didn't help, nor did the bulk and weight of the device, which prevented its use in tight indoor locations like retail shops and restaurants. Now, while Cayman did manage to foster commercial adoption for warehouse workers, postal delivery, and national parks tourism, the Segway never really penetrated much further than that. And that brings us to our question of the day. How many of the original Segway PTs have been sold? While Cayman had dreams of millions of people riding the devices, ultimately, just 140,000 were ever delivered over the course of 19 years. The device, of course, would go on to become the butt of jokes, central gags in the hit film Paul Blart Mall Cop and the hit TV show Arrested Development. Also damaging its image were questions about safety. British businessman Jimmy Heselden, who bought the company in 2009, died months later when his Segway that he was riding went off of a cliff. U.S. President George W. Bush was famously caught on camera tumbling off a Segway, and in 2015, you see it there, a cameraman riding a Segway couldn't stop in time before running over world record sprinter Usain Bolt. But that doesn't mean that the Segway was a bad product. It wasn't. It was the first consumer application of drive-by-wire technology in which software, not mechanics, makes the machine turn, accelerate, and stop. And that was revolutionary. It was a technology that was rare back then and ubiquitous today, which means that for Segway, unfortunately, it was just a bit ahead of its time.
All right. Well, I'm just going to wait for the next Paul Blart Mall Cop version that features, a hit film that features the next version of the Segway. Let's now segue to 2024. Today is Giving Tuesday. It's an annual day of giving or showing up for an issue that we care about. So in light of that, we had an exclusive interview with the leaders of Jersey Mike's Subs and Best Buddies International about their partnership to hire people with intellectual and developmental disabilities in each of Jersey Mike's nearly 3,000 stores. Take a listen.
And I think people are starving for community, and I think Best Buddies offers such a great community of caring, community of giving, community of support. And I think, with Peter and Jersey Mike's and the support we get from corporate America, international companies, it's a great combination because job opportunities for people with intellectual disabilities are so sought after and so necessary since the unemployment rate's 85%. And making people with intellectual disabilities feel like they're part of a corporate culture and a corporate culture that gives and cares. And recognizes that, as I keep saying to Peter, you can make a lot of money and do good at the same time. And I think a lot of corporations don't really recognize that and understand that you can really be profitable and really do good. And they go together.
And Peter, I mean, your involvement with Best Buddies is relatively new, but your involvement in giving and dealing with some of the issues that Anthony just talked about, you've been doing that for years, decades.
Yeah, so first got involved in 1975, believe it or not. So watching Bob Hoffman and Jack Baker, local business guys, gave to the community, to the first aid, to the kids programs, and I said, that's what we're going to do. So we always gave from the heart, and that's our mission statement, and we have all of our owners that get involved as well. But Best Buddies, I mean, so great. Every store has about 15 employees, small team, and when a Best Buddy joins, become part of that family and the community that they serve. It's really just a magic touch.
Anthony mentioned that you can make a lot of money and do good at the same time. I know that you recently had a fundraising bonanza week where you raised a lot of money and also brought in a lot of sales. Can you talk us through some of the numbers?
Sure. So we went with a campaign during election week, and even Tuesday we're on the major news networks running the ads, and then the college football game of the week. Our whole media plan was geared towards Best Buddies, and I think the whole nation came out. And usually we raise about $4 million on the special weekend programs that we do, but this weekend we raised $5.3 million. So incredible turnout, incredible success for the cause.
And Anthony, the program allows for Best Buddies to work in Jersey Mike's stores.
Yeah.
The idea is to have at least one Best Buddy in every one of Jersey Mike's almost 3,000 stores. What's been the feedback from those who are working there?
I mean, it's huge, right? I mean, it's a game changer for us. I mean, I've been at this 35 years. I think, my mother wouldn't believe that this was happening when she started Special Olympics in the 60s, that, a corporate leader like this commits that kind of money, that kind of creativity, and commits to that number of jobs. There's no company in the world that has committed to 3,000 jobs in the history of this operation ever. So it's a really huge monumental step in the right direction for the employment of people with intellectual disabilities, and really making them feel like they count and they matter and they have a seat at the table.
I do want to talk a little bit about your origin story, because just kind of the whole creation of Jersey Mike's is kind of like, it's like a Hollywood movie. You're basically a teenager who somehow manages to pull together $125,000 or whatever it was. You buy a local submarine shop, you turn it into this big franchise, and you just recently sold it off to Blackstone for a good chunk of money now.
That's how I heard.
And billions. And everyone watching this and watching the trajectory of your career, I think would want to model themselves, not just because of the success and the money that you made, but also to what Anthony's getting to is the ethos and the culture of giving that sort of helped to fuel that.
I think a lot of people, they come into the stores and they say, hey, we hear what you're doing for the community, for the kids, and that's why we're here. And oh yeah, your subs are good. That's almost secondary, and it's kind of funny, but it's something that we've always done, and all of the owners really get it, and they're all engaged in it. So that's what's so great. So it was a football coach of mine, youth football coach that was a banker, and on a Sunday night I went in and said, hey, he said, I think we can do something, and he did. So 17 in high school, took over, went to homeroom history class and skipped gym and a few other classes, but they finally did graduate me and then just worked the business. So I call it 50 years overnight success. This March will be 50 years.
Wow.
So a slow climb from really the last decade, with the media and the marketing, but the giving has been just nonstop.
Talk about the managerial and industry-specific support you anticipate from this partnership with Blackstone, and how you're going to keep that corporate culture, which includes partnerships with Best Buddies, intact.
Well, they get the corporate culture. They see it, they understand it, and absolutely will continue with it. They see that it's part of our huge success that we've had, that people accept us in every community we go in, and it just really takes off. The brand now is so strong. But them coming in and getting involved, great international possibilities. We're close to an announcement with London, England, United Kingdom, maybe in a month or so. We started in Canada, outside Toronto. So the expansion looks great. Of course, the U.S., we have a long way to go as well.
I got to ask one more final question about the path forward for Jersey Mike's now that this Blackstone deal has been announced. Sure. You're known for being a very hands-on owner to your franchisees. How do you anticipate that evolving with Blackstone's partnership?
Well, January, I go start January, February, March, go to 35 cities across the country to make sure we have a great transition, to answer questions, to get in front of managers, assistant managers. So that will continue very strongly. And also in England, I'm going to be driving sites with the owners, and I love that part of it, just being involved. And of course, still slicing the subs. I'm still the fastest slicer.
Peter Cancro there, of course, the billionaire founder of Jersey Mike's Subs, alongside Anthony Kennedy Shriver of Best Buddies, talking not only about his business, but more importantly, Scarlett, obviously, some of the charitable work that he tries to sort of facilitate through his business with regards to Best Buddies and dealing with people with intellectual and development disabilities. A great project.
And a great way to highlight that on Giving Tuesday. All right, let's take a look at how markets closed on this day. We had the S&P 500 notching its 55th record close. It finished just barely in the green, but it still counts. The Russell 2000, small caps have been outperformers since the election. Not today, down about 0.75%. Yields move slightly higher as everyone anticipates Jay Powell's comments tomorrow and the jobs report on Friday. And the Korean won, boy, it's been on a big move. Still weaker, obviously, because of all the political turmoil there.
Tech was sort of the big leader in U.S. markets today, and in the after-hour trade, it remains the big mover. Pure Storage, Okta, Marvell, and Salesforce are the four biggest gainers in the after-hours trade. The application decision software maker Okta a beat and raise on its most recent earnings report. Pure Storage, enterprise storage company, also a beat and a modest raise on its forecast, a 23% jump in the stock right now. And then take a look at Salesforce, up about 7% here, despite the fact that it missed on EPS, despite the fact that its forecast really didn't change materially from what it had previously said. But there is a lot of promise and hope here about its new AI agent and what that could mean for the top and bottom line. And at the top of your screen, Campbell Soup taking a leg down, losing its CEO of roughly about 5 years, Mike Klaus, leaving to become the president, the team president of the Washington Commanders football team, despite the fact he has no ties to Washington, no experience in the NFL or sports, but he has been a longtime manager in the food space.
That counts for a lot.
It counts for something here. And of course, one of his deputies will be taking over for him at the start of the year. We'll be back in a moment. This is Bloomberg.
It's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up has to be South Korea's President Yoon Suk-yeol. He stunned voters, lawmakers, and investors by declaring martial law. And then about 6 hours later, he lifted it in response to lawmakers' vote to lift the order. He was trying to prevent the paralysis of his administration because there's this protracted budget battle, but I think he just made things worse for himself.
Yeah, this is very confusing. As you probably know, I don't follow South Korea politics very closely, but this took us all by surprise. This all kind of happened in the overnight hours in South Korea time. You saw a market reaction here in the U.S. with the ADRs and some of the ETFs here. Who knows what his future is, but obviously they have to get something sorted out. And as we talked with several of our guests today, we can't deny the fact that South Korea is a huge economic partner for the U.S. and obviously a huge strategic partner as well. I'm keeping an eye on a guy named Terrence Riley. You might not have heard his name, but you certainly know his work. He's a guy really credited with turning Crocs around. And you know all those Stanley mugs you see everywhere?
The gigantic
Blame him. Anyway, he is a marketing genius, and he left the company, Stanley, a little bit earlier this year to go over to Hey Dude. This is Crocs' casual footwear brand. And there's a lot of talk now about whether he can sort of work some of the magic on Hey Dude that he did with the original Crocs and, of course, later with Stanley.
Yeah, he said his marketing secret sauce is not about the data, it's about the feel and the emotion.
I like that, and I know that a lot of executives are bristle at that. They want to know the data, but you think about some of the great creative minds we've had in business, Johnny Ive and some of these other folks, and the idea that a lot of what they do is from the gut, and sometimes you have to trust it. I know if you get the wrong person, it doesn't work. But when they get it right, you just have to let them run.
Well, this guy has a proven track record.
He certainly does, and something I'll be keeping an eye on.
Someone else with a proven track record is Oprah. She has a new platform, a weekly podcast airing on her YouTube channel called The Oprah Podcast. She'll be featuring book club authors and guests, and they're partnering with Starbucks, by the way, Romaine, for the interviews with book club authors. They'll be filming in Starbucks cafes, and the books will be paired with a Starbucks drink as well.
Oh, wonderful. The only thing that surprises me by this is that Oprah didn't already have her
That's
own
what I thought
podcast.
too.
But, there you go. She can't do everything. I'm sure you're fans of Oprah. You can tune in to her podcast. But there's also another platform out there that allows fans to have a more intimate experience with their favorite celebrity. I don't know if Oprah's on this platform, but maybe she should be. It's Cameo. Remember, it's the popular service where users can pay public figures and influencers to make video messages in their honor, whether you want Ghostbusters actor Ernie Hudson to wish your parents a happy anniversary, I should say, or rapper Dougie Fresh to give a shout out to you on your birthday.
Or Aaron Boone, look.
As he did for me. Don't step on my happiness with Dougie Fresh. Stephen Galanis joining us right now. He is the CEO of Cameo, joining us here in Studio 2. All right, Stephen, let's talk about this, because when Cameo really came, or at least came to our attention, primarily during the pandemic, it was kind of this huge Rorschach test of how we view celebrity and fame, and of course, the business and commerce that goes all into it here. How is business right now?
Business is good. We're going to be full year EBITDA positive for the first time ever, so we're really excited about that. And one of the things you got to think about when you look at what happened with COVID and what's happened coming out, all the trends that were true for us to start Cameo 8 years ago are more true today than they were before. There's more famous people today than there were yesterday. There's going to be more tomorrow. So the pipeline continues to get strong on the supply side. When you're thinking about the underlying business models of sports or entertainment, it's still true that most NFL athletes go broke 5 years after playing their last game. It's true that for YouTubers, the top 3% of creators make 97% of all the ad revenue.
Right.
So there's people with literally millions of followers that can't pay their rent. And that's why direct-to-fan monetization has been so important.
And we've seen that sort of dominate the site in terms of the types of celebrities that
Absolutely.
are on there. There has been a big question about competition, whether TikTok gets into this game, whether some of the other social media platforms. I mean, where is the moat for Cameo? Because we talk about what was certainly a great idea, but it was also an idea that can be replicated.
Yeah, look, it's a brand vote, number one, and the network effect.
Yeah.
When people see a video, they call this a cameo now. So far, everybody's come and taken their shot. You know, we've survived a Facebook attempt to copy. We've survived Snapchat, Google, bring it on.
And now you're making a change to your policy in terms of talent recruitment. You had certain rules and restrictions in terms of who could be on the site, on the platform.
Yeah.
But now you're opening it up to a broader group of content creators. Talk us through what that means.
Yeah, first off, the nature of fame is changing drastically. You know, when we were younger, if you were on cable TV, that was the only outlet you had to be a television star. Today, if you have a YouTube or a TikTok, like you can be your own channel. So there's way more channels today than ever before. What we realized when we looked back at all the people that had applied to join Cameo, so we've always had 3 ways you could join. We could reach out to you, somebody that's on the platform could refer you, or you could apply. You'd put your social handles in, here's how many followers I have on TikTok, on Instagram, on Snapchat. We would review it and we'd say yes or no. We looked back from March of 2020, beginning of COVID, to last Mother's Day, and we saw that there were over 100,000 people that we hadn't let on the platform.
I see.
When we looked back at that, we realized that we'd missed thousands of people that could have been impactful on our marketplace. Might be an actor who hadn't had their breakout role on a new Netflix show. Might have been a rapper who hadn't blown up on SoundCloud yet. Might have been a politician that was in office and suddenly they weren't in office.
But how do you convince those people to get on? Do you have to pay them up front, or or is just the promise?
These are people joining themselves.
Yeah. Okay.
So our take rate, it's a 70-30 split. The talent set their own price. We take 30%. They take 70%.
Yeah.
So beyond the brokering and housing of these customized video messages, how do you see the use case of your content evolving over the next couple of years?
Yeah, well, one of the things that's been really interesting as we've opened the platform up is we're seeing very different use cases than we saw before. So now tarot card readers, astrologists, different things like that might have been like niche use cases on Cameo. Now, people that might not have the 25,000 followers we've recruited in the past, but they might be the best tarot card reader in the world. They could join the platform and be successful.
One criticism about the business model is that, let's say you receive a Cameo.
Yeah.
Like, I don't go back to the site. Like, I got a Cameo a couple years ago. My wife sent me one from Dougie Fresh, and it was fun. It was great.
Yeah.
But I never went back. Like, how do you keep people engaged where they come back to the site, they use the site more rather than just have it be a one-off?
Well, one thing you probably did, I'm sure when you got the Dougie Fresh Cameo, you shared it to your group chat.
I did.
Every Cameo becomes a commercial for the next one.
Yeah.
Exactly. So whether you went and bought it or that person bought you another one, the fact that they're getting out there is important. That's why in this new model, we'd rather sell $1 million $1 cameos than $1 million cameo, because every single cameo is bought for someone else. It's shared, and that's our K factor. That's how we grow.
I'm sure Dougie Fresh makes enough money that he doesn't need to rely on the Cameo revenue, but does anyone who works with Cameo earn enough to actually make a living?
Sure. I mean, it depends what your standard of earning a living is, but in the creator economy broadly, we talk about having somebody make at least $100,000 a year to sustain themselves, pay their rent, not have to work. To do that, you really need 1,000 people to give you $100, right? That's really what you do when you break it down like that. But we have people that earn 6 figures, 7 figures a year on the platform, including most notably in this new world that we opened up, a puppet named Mona Nanoland, who's made over $600,000 this year since they self-onboarded.
This is interesting.
The highest tax bracket, by the way.
Yeah, and it's interesting too. I mean, you mentioned the puppet, Mona, and there's some other folks that have come to the site that probably maybe in the past wouldn't have been there.
Yeah.
I am curious that as you try to broaden this out, how do you also make sure that, I guess for lack of, I hate to use this phrase, that it's a safe space, that you're not getting people doing things that are inappropriate in some way or another?
So number one, we've always been a big tent.
Yeah.
We've always let pretty much anybody on unless they were sanctioned by the government. There used to be thresholds of followers, but we have 3 main rules on the platform. No nudity, no inciting violence, no hate speech. We care what you do on the platform. I can't police what you've done on other platforms, but I can police what you do on our platform. And if you break our rules, we kick you off.
How many cameos have you yourself done?
Like it made his talent or
were you that you made?
I've made over 1,000.
Wow.
Yeah.
Stephen, a pleasure to meet you. Thank you for coming in. Stephen Galanis is CEO.
I think I might
Cameo.
order one from him tomorrow.
I think we should do
I
that.
got some birthdays coming up. All right.
What's your price, by the way?
$10. I go on sale for $3 a lot of times.
Sold.
But for both of you guys, SG25 is always my personal promo code, so you can get 25% off.
All right, Stephen Galanis, love it over at Cameo. Stick with us. We'll be back on the close, setting you up for what to watch over the next 24 hours. This is Bloomberg. Here's some potential market moving events over the next 24 hours and includes a look at some big consequential earnings tomorrow in the retail space.
Yeah, we have a bunch of them, including from the retail space. Dollar Tree, American Eagle, Foot Locker, Cracker Barrel. Campbell's did end up announcing today.
Economic data, including the ADP employment report, as a prelude to Friday's official government job report and Fed speak from the one Fed person that matters most.
Yeah, Jay Powell, but also Muslim and Daly will also be speaking.
And keep an eye on what's going on over there in France. The French prime minister facing a no confidence vote that could potentially topple what seems to be a relatively tenuous government coalition. That does it for us here on The Close. We'll be back tomorrow, but stick around. All your politics news coming up next on Balance of Power right here on Bloomberg.